Good evening and a very, very warm welcome to all of you for joining us today. And I'm promising you, you won't be disappointed. We got a star-studded panel to discuss the union budget. And let me just introduce them before I go any further. We have Nilesh Shah, Senior Vice President, Bombay Chamber, and Group President and MD Kotak Mahindra Asset Management Company Limited. Professor Ananth Narayan, Associate Professor and Head of Public Policy at SPJIMR Research and Mr. Utpal Sheth, Founder and Mentor of Trust, Abizer Diwanji, Head Financial Services at EY, and to moderate this session, we have Dr. Sachchidanand Shukla, Chairperson or Chairman, Economic Policy Research and Development Committee, Bombay Chamber, and Chief Economist at the Mahindra Group. Uh, so we all are looking forward to today's deliberation. As you all remember, those who joined us on the 27th, we did some crystal ball gazing as to what the budget would look like and how from here we would achieve the $3 trillion economy in 2047. Again, we got a lot of feedback that this is a session which people really appreciated. And I'm sure today's session would itself be something which we will all take home as to what the final points of the budget are. Before I hand this session over to Dr. Shukla, I would just like to thank our partners, Kotak Mutual Fund, Axis Bank, Tata AIA, and Sai ALP. So with that, over to Dr. Shukla. Nilesh bhai, till Dr. Shukla joins us, over to you to fill in for him. Abizer and Dr. Shukla are just joining in a couple of minutes.
Okay. So, welcome Utpal bhai, welcome Professor Ananth. Pleasure to have you at Bombay Chambers of Commerce. While fielding for Dr. Sachchidanand Shukla, can I request Professor Ananth to give his initial inputs on the budget?
Thank you, Nilesh bhai. And in fact, this is totally unfair. I was hoping to hear your views first. Actually listen to your views. But anyway, you're fielding in for Dr. Shukla, who I think has managed to come in. But thank you. And thank you, Sandeep. Thank you, BCCI. Thank you, Sachchidanand, for the invite. Thank you, Nilesh bhai, for stepping in so ably to fill the breach. Very quickly on the budget. Look, I think the clear thrust of this budget was capital expenditure. And this is a trend which has been seen for the last two budgets, not just this budget. In fact, from fiscal year 2011 to fiscal year 21, the average capital expenditure as a percentage of the total expenditure of the central government used to be about 12%. For this fiscal year FY22, it was raised to 16%. For the next year, it's now budgeted to be 19%. So it's a clear shift in terms of pushing more and money into capital expenditure. Now, we can quibble about how much of it is real, how much of it is adjustment of the past sins, like the Air India or the FCI, or for the next year, NHAI, etc. We can quibble about it, but the thrust is very, very clear. The money is going towards capital expenditure. Now, one of the issues which comes up for debate is it too much of money into capital expenditure at a time when there is still distress in the economy, particularly the lower half of the economy, given COVID, etc. And should more money have been set aside for giving support to people and to try and instill demand? Now, I know this is a controversial topic, but my own view here is I think this is absolutely the right thing to do, to push for capital expenditure. And I'll tell you why. I think not just through COVID, for the last 15, 16 years, our biggest problem has been gainful employment, jobs and output. In 2005, Nilesh bhai, you know this, as per International Labour Organization, our employment to population ratio above the age of 15 used to be 55%. During COVID hit 2020, it came down to 43%. Even before COVID, it was down to the low 40s. So clearly, that's been a big issue. And our requirement, therefore, is gainful jobs. Now, it's that old story about, do you give a man a fish or do you teach him how to fish? I think the point is to try and create gainful jobs. Narega is not gainful jobs. You have to create actual gainful jobs across manufacturing, services, MSMEs, and all of that. I think the thrust this government is using is the following. One is put money into capital expenditure and infrastructure, which is roads, railways, ports, renewable energy, etc. That's the first pillar. The second pillar is you try and give incentives for industry to come in. There is a China plus one mood, so people do want to come in. Plus, domestic people are also waiting to come in. So you give production-linked incentives. You try and ease the ease of doing investments. You try and improve labor laws. You try and reduce tax rates. Essentially, make it profitable for people to at least start investing into manufacturing and into other new businesses. That's the second thrust. The third thrust has been things like privatization. Essentially, try and get more private capital inside, incentivize people to think about that. And of course, as the fourth part, which I've already covered in ways, enabling legislation like labor laws, etc. Now, budget cannot cover all of this. It has done the first part of putting aside money for capex, which I'm absolutely happy with. There are some caveats, though. First is, it's nice to put money aside. It's nice to identify projects, but eventually it boils down to actual implementation. Unfortunately, our track record in implementation is not that great. The good news is there is a lot of focus on individual projects and trying to see them to completion. In fact, there is a report which comes out every month from the central government, which talks about those 1,680 projects. Just may say only 280 odd are running on time. 500 odd are delayed by 3 to 4 years, and for 800 we don't even know the status properly. And the issues are the same: land acquisition, it is environmental clearances, legal issues, capital, financial closure, and so on and so forth. But the good news, again, things like, for instance, I see the progress on freight corridors happening very, very well. I think there is a lot of focus on trying to close that, so hopefully that will happen. So my two quibbles really are, of course, implementation. Hopefully we'll have to work it out. If at all I have quibbles with the budget, it is twofold. One is education, healthcare, sanitation, etc. I would see them as important as the hard infrastructure of railways and roads. Particularly in education and healthcare, I don't see enough money being put aside. I wish between state governments, of course, a bulk should be taken by the state governments, but nevertheless, between state and center, I wish there was a lot more focus, particularly on healthcare and education. I think there are bigger investments which will lead to jobs and output over a medium-term period. I don't see enough there. The second quibble, I guess, is that the projections done for revenues are extremely conservative. My father was a curd rice eating man who would always be, under promise, over deliver. I think they've gone completely overboard on that, which is visible in this year also, Nilesh bhai. If you're increasing your revised estimates for revenue collections by 3 trillion rupees, 1.5% of GDP nearly, that is ridiculous. And next year also, they've completely underballed. I can see at least 2 lakh crores more of money coming in on revenues. Even without, big items on asset sales, etc., I think the money would have come in. If you had projected more reasonably, your fiscal deficit numbers would have been lower. Your borrowing requirement would have been lower. And unfortunately, you've left a very bad taste and a lot of fear in the bond markets and amongst people about inflation and all that, which could have been easily avoided. So look, I scored this budget very highly on the shift to capex. It wasn't easy. It is easier and more populist to give doles out. But I think the shift towards capex investment is absolutely right. I wish we would count education and healthcare as capex as well. And a quibble, the revenue projections are terribly low. Our budget deficit need not have been this high. The borrowing program need not have been this high. This could have been managed a lot better. I'll stop here for the time being, Nilesh bhai.
Thank you, Ananth. Sachchidanand, now over to you. I just requested Ananth to start giving his views on budget. And let me just supplement Ananth. This budget, last budget, actually, I thought it was like Sita and Gita movie. Finance minister moved from being a Gita to Sita, more adventurous and bold. And this budget is like the old Hindi movie of Navrang. There was a song played by Sandhya, where on one side she was female and other side she was male. And the song was something like Are Jare Hat Natkhat. So this is budget where on one side equity markets were happy and the debt market, for exactly the reason mentioned by Ananth in terms of conservatism on revenue estimate, was kind of annoyed and yields have gone up. So this is more like a Navrang budget to me. But over to you, Sachchidanand.
Thank you so much, Nilesh bhai. Sorry, folks, for some technical glitch. You can always expect something like this when you least want it to happen. Welcome, everybody. We have an excellent panel today. A lot has been spoken on about the budget. I mean, people have dissected it threadbare. But one thing that I can promise you is we will still get nuggets of wisdom and some incisive uh, analytical points from each one of our panelists today. Um, and I think Professor Ananth spoke about the backdrop, why the budget really focused on capex. But as we move along, I just want to tell you how I'm going to curate this discussion. Will probably be going around the panel to each panelist, asking them maybe a couple of questions each, and answers of about 4 to 5 minutes each, and then finally a rapid fire round before we open for Q&A. So having said that, let me quote somebody called George Allen Sr. And he said, forget the past, the future will give you plenty to worry about, right? With that, Nilesh bhai, let me come to you. While the budget has spoken about growth being the focus, we all know growth is the tide that lifts all boats. And the strategy is largely crowding in private investment and government taking the lead on capex. But Nilesh bhai, let me be a little bit provocative and let's peer into the future. This entire capex story, how credible is this? We have seen various uh, variations. A lot of people talking about that this number is actually only 12% or 14%, depending on how you adjust for Air India and some of these other one-off expenditure items. And also, Nilesh bhai, we've seen this story for the last, say, 7, 8 years in a row. Capex seems to be coming, and this rotation, sector rotation, everybody hoping for into Capex, just somehow doesn't happen. What's your view? How do you see the Capex story? How credible? And how do you see this panning out over the next, say, 12, 18, 24 months?
So as you mentioned, Sachchidanand, I'll also give nuggets. Uh, there is a 35% increase over budgeted estimated FY22 in FY23 for capital expenditure. But it is 25% over revised estimate. And it is 10% once you create a like-to-like comparison. So numbers are numbers, you can fit in whichever way you want. But government capex is just one portion. Today we are seeing capex cycle beginning in steel, aluminium, and electrical and electronics apart from renewable energy. Cement and sugar is also on its way towards capex, whereas some other sector might be behind. So overall, is capex slowly but steadily recovering upwards? Answer is undoubtedly yes. And I'll give you one just small example. The total capital investment by listed companies put together, Tata's, Birla's, Ambani's, Adani's, and listed government companies, in a year is about $75 billion. This year, PEVC flows will be $75 billion. Now, some of it might be exit, some of it might not be investment. But just the startup community alone this year will be equivalent to Tata, Birla, Ambani, Adani, and listed PSUs put together. So while we are focused on government capex, a lot is happening outside of government, and where you can either call glass half full, looking at renewable energy investments, metal investments, cement investment, or startup investments, or you can call glass half empty when you see some of these sectors like uh, automobile pulling back their investment plan. But overall, it looks like that we are coming out of the winter of investment. Summer may be little away, but it is definitely warming up.
Thank you, Nilesh bhai. Really reassuring in terms of what you say for the capex cycle. Um, Moving on to Professor Ananth, I think you have been talking about the jobs problem, some of these social issues. The pandemic has actually accentuated the chasm between the haves and have-nots the world over, right? India is not an exception. We probably need a new social contract that will fundamentally reorder and equalize how opportunity and security are distributed across the Indian society. In your view, do you think the budget has done enough to address some of these near-term K-shaped issues that we see in the Indian economy? Obviously, one budget is not enough, but near-term, do you think it has done enough?
So, Sachchidanand, this is a controversial and contentious topic. As I was telling Nilesh bhai earlier, there are a lot of people who are saying that much more could have been done as far as social help is concerned, given that there are jobs. There is definitely a K-shaped recovery. I think everybody agrees now. The organized sector, the larger companies are doing phenomenally well. Look at the profit after tax for about 4,000 odd companies is up by more than 100% from pre-COVID times. Your formalization has really increased. The number of retail payments through formal systems, ecosystems have gone up from what used to be 150% of GDP before demonetization. It's now at 220% of GDP. So formalization has definitely happened. And all of that is reflecting higher GST, etc. But at the same time, when you look at the jobs data, whether you see CMIE or even if you see the periodic labor force surveys of the government itself, it paints a very, very poor picture as far as job creation is concerned, especially of gainful job. And particularly amongst women, Sachchidanand, the participation of the women in the labor force is very, very low. It's comparable to, frankly, your Arabic countries, which is not something to be proud of. Now, there is much to be done, therefore, as far as job creation is concerned. Now, my point is, look, the government has done a lot as far as providing some kind of safety net is concerned through COVID. Now, I hate to say things like this, but the reality is we did not see, thankfully, any starvation deaths through the last 2 years, despite all the distress that we saw. And that's because we had a reasonably good food program available. We also had, money being given to the hands of, through the Kisan Yojana, etc., to the hands of people who required it. So the basic sustenance was at least taken care of. Yes, more have been done. Everybody wants more definitely could have been done. But the medium-term solution to this, Sachchidanand, is the provision of jobs, and that too gainful jobs, not Narega-type jobs, but actual gainful jobs. And you have to go through the hard grind of a medium-term strategy for generating this. You cannot do this overnight. You cannot wave your hand and say, boss, MSMEs will create jobs. Nahi hone wala hai. So to that extent, I think the focus on capex, on infrastructure, enabling infrastructure, both in terms of starting construction and therefore creating some jobs now in the short run, but more importantly, enabling therefore industries to be set up, as Nilesh was saying, create incentives for people to come in and start creating investments into manufacturing, I think is absolutely the way to go. And the opportunity space, Sachchidanand, is so visible. If you look at our trade deficit with China the last year in 2021, it is at an all-time high at $64.5 billion, right? And the nature of the trade deficit is shameful. The fact is we are importing electronics, we are importing plastics, we are importing chemicals, we are importing fertilizers, we are importing all kinds of machinery and machine parts for every single equipment in our house. All of these are manufactured products. Our exports have also gone up, but it's things like ores, cotton, sugar, etc. It's almost like a colonial relationship. So that manufacturing imports that we have can definitely be replaced by our own Atmanirbhar Bharat ventures like PLI, ease of doing investments and infrastructure. That's the plan. So I absolutely like the plan. I think that's the way to go. As I was telling Nilesh bhai earlier, the one issue I have with all governments, state and central governments, we simply are not putting up the same 35% that Nilesh bhai talked about as far as capex is concerned. I wish you would see a 35% increase in education, budget or in healthcare budget with the same kind of, perseverance. Because yes, you might not be able to deploy all of it, but the message is required that, boss, we have to solve for education, healthcare, and nutrition of our children. They will take care of us in the future. So that's one quibble I have in terms of this K-shaped recovery addressing in the medium term. But the focus on infrastructure for creation of meaningful jobs and gainful jobs, I think is absolutely the right way to go.
Thank you, Ananth. Well said. In fact, you captured the whole story very beautifully in a very short time. Utpal bhai, you have been an observer of the markets very closely. I mean, you look at things with probably a lens much more focused than some of the other people. I just wanted to point out, I mean, if you look at how markets have suddenly changed the way they look at things, they become suddenly very unforgiving. So, for example, Meta, just a couple of days back, you saw it lost about $251 billion in a single day, right? And then the very next day, Amazon gained about $191 billion in a single day. There is this huge debate amongst global investors, not so much in India as of now, over growth versus value, right? And uh, if you look at value investors, they've probably underperformed, especially the US markets, for more than a decade now. They do see some sense of opportunity now. How do you see the Indian picture, the big picture on asset allocation in the short to medium term?
Okay. So first of all, thank you for the privilege of inviting me to this session. And I would like to share that we are living in a very, very different world than we used to when Nilesh and I started our careers. Okay, we are living in an abundance of capital kind of world. Okay, and there are some very, very powerful dynamics playing out globally, both in terms of the monetary accommodation and the fiscal push across all geographies. And at the same time, we are having unprecedented disruption in the form of accelerated shift to a digital world, some say a virtual world, uh, as well as an accelerated shift towards net zero carbon, etc. So I feel that we are in a very, very unprecedented situation. There is no point in extrapolating the past into the future at this point of time. In fact, people like Nileshwa and me have the baggage of the past in our minds, and we need a completely different mindset and an approach um, to this new world. It's not that the fundamentals of investing have changed, the fundamentals of investing will remain the same, but the pace of change has accelerated. Hence, you are seeing what we are seeing. Now, you specifically talked about Facebook and Amazon. That clearly shows how the big have become bigger, and that the biggest advantage of these powerful mega trends that we are seeing all around us in different ways is being taken by the largest of the companies, is being taken by the leaders in each sector. We are seeing competitive intensity reducing across each sector. And we are seeing record corporate profits to GDP, whether it is US. And in India, we are seeing a record jump in corporate profits to GDP. So this jump in corporate profits is providing a floor to the market. And any challenges with regard to monetary policy being recalibrated will act as a short-term cap for the markets. So I would say we are range bound in the short term. However, in the medium term, this structural change of greater access, greater inclusiveness to global growth, um, the structural change of all these disruptions, and the structural change of concentration of leadership is resulting in a structural improvement in corporate profits to GDP, and that will act as a floor to global markets. We are very optimistic about equity. We continue to be optimistic about equities in the long term, and even in these markets where we've had pockets of over exuberance, we're still finding opportunities in this market.
Thank you, Utpal bhai. Abizer, if if I look at the previous decade and even prior to that, maybe the 2000s, mid 2000s to till the GFC, there has been no abundance in terms of optimism on our infra plans, right? We've always had massive infra plans. I mean, you talk about that uh, the new plans that we have. We've also had now something called as Gati Shakti being introduced with 7 engines thrown in roads, railways, ports, and all of that. We also have lots of tongue twisters. I mean, acronyms like NARCL, NABFID, INVITS, and all of that, which really clutters the mind. But you look at the infra space in a very very discerning way. I just wanted to ask you if you think, with all of the past, like Utpal Bhai said, baggage of the past, when I look at all the massive infra plans and the ambitions that we've had, plus these things like NABFID, NARCL, Gati Shakti, etc., do you think we have what it takes for the infra push? For example, capital base, is it adequate for NARCL, the asset recovery timeline of 5 years, or NABFID, the paid up capital of 20,000 crore, and plans to leverage it to say 3 lakh crore? What are the issues and positives or negatives that you see in the framework, the institutional depth and requirements?
Yeah. No, so thanks, Sachchidanand. Uh, as Utpal rightly said, all of us here are kind of the past, talking about the future. And unfortunately, you normally call people who have the experience, but they have the experience of the past, and that colors our vision of the future sometimes. But as what Ananth also said earlier, that we have a very poor track record of pipeline. We have ambitious plans and poor track record of pipeline. And I think over time, whatever we have been doing is we've been trying to create institutions. So if you look at it, we had created institutions earlier like the IDBI and the ICICIs to specialize and do infrastructure projects. After we specialized them, we realized that their cost of funds were too high to sustain an infrastructure development. Hence, they said, let us become universal banks so that they could attract deposits. Then they became universal banks with cheaper deposit base, but slowly blunted their ability to do infrastructure lending. And they got into consumer banking, and ICICI, as everybody knows, converted into a 60% consumer bank over a period of time. IDBI got somewhere lost in between, tried to convert itself into a consumer bank, but never succeeded. So what really happened is, over time, we blunted our ability to do infrastructure lending. And if you ask me today, the only credible infrastructure institution we have is a project finance division sitting somewhere in SBI, which possibly is the only good infrastructure assessment entity that we have. So what are we doing now? We are coming back the whole circle, and some of our experiences of the past are relevant in the future. Is that they are now getting Mr. Kamath back and asking him to revive something of an infrastructure bank again, which will house the assets. So as I was talking to some PSU chairman, and I think this is a good, I'm talking about these things in a good development form. That what we are doing is that we needed one good nodal agency. At one stage, IDFC was supposed to be that. But maybe IDFC also converted into and succumbed to being a commercial, a retail bank. But really what we want is this infrastructure bank to come up and find some source of funding, and markets have matured, and as everybody has said, the markets are liquid and will remain liquid, though interest rates will go up gradually over time. They will continue to remain liquid to attract more money. So I'm not sure whether a 30,000 or 20,000 crore initial capital base will lead to 3 lakh crores or no, but it will lead to a substantial number. But again, as I was telling to some of the PSU bankers, that basically on the back of a good infrastructure bank, which will impact policy making. So the issues that Ananth said, same old issues, land issues, environmental issues, blah, blah, blah. Everything which is outside of a financial institution's ambit is impacting infrastructure lending. And really what we need to do is control some of those uncontrollables. So for example, if we are overseas, it happens. The only risk you take is credit risk. And in India, what happens is that the people who actually sponsor the corporates or the promoters who actually sponsor infra funding are people who can manage those external risks better. And unfortunately, people who can manage those external risks better don't have the capital to put in. So capital almost entirely comes from the banking system. What is required is we need to have somebody who takes care, and I think National Infrastructure Bank should do that, ability to influence policy, do a good first level or junior credit, and then get the banks, which will hopefully have cheaper costs of funds, to come and do senior credit. And that is how financing has to be closed. And if you are able to close financing that way, and I think we are headed that way, as I said, the institution building blocks are there. You spoke about the fact that we have created NARCL also now. Infrastructure, if you look at the past, in 2018-17, we had a 20% delinquency in infrastructure projects. Now it is impossible to do any kind of financial closure with a 20% delinquency in a sector. And most of it, again, are outside of that of the banking sector. So it is impossible for the banking sector with all covenants to manage that. If somebody decides to cancel coal blocks, you cannot do much about it. Or somebody decides to have cancel 2G licenses or 3D licenses, you can't do much about it. How do you fund these infrastructure projects? So consistency of policy is something that we have to ensure over time. And if we are able to do that, almost certainly we will get the kind of funding. So I think there is a little bit of a cart before the horse fixing that we need to do. And if that happens, and I think government seems to be quite aware, because now that we have national infrastructure pipeline, which is quite large. So there is promise being showed to investors that there is pipeline available. There is a monetization plan available. And totally you're talking about 6 lakh crores and 3 lakh crores on. So 10 lakh odd crores worth of monetization plan and infrastructure pipeline is available. All we need to do is have a sectoral advocacy to make sure we are able to control the uncontrollables, and funding will be available.
Absolutely. Nilesh bhai, coming back to you, you can choose not to answer this. Essentially wanted to ask you your perspective on the absence of the withholding tax for the FPIs, which the bond markets were expecting. We know equity markets were really worried that the budget may turn out to be a populist one, or try to target the super rich and things like that. Whereas the bond market was hopeful for a lower borrowing number and this tax saw. Your perspective on this, and do you see this bond market yields rising? We've seen yesterday globally yields spike everywhere in the world. Do you see this risk percolating from bond markets into equities?
So Sachchidanand, if I was drafting this budget, I could have easily shown the fiscal deficit instead of 6.4% at 3.7%. There is surplus on divestment, small savings collection, cash drawl, tax collection, and RBI dividend. We don't know whether it is 6.4 or whether it could be 3.7. I'm sure the number will be somewhere in between. Now, the equity markets are saying that this surplus will be used for capital spending, and that's where, like the budget. The debt markets are worried that in 2020, when you had surplus, you took over Food Corporation's liability on your balance sheet. In 22, when you have surplus, you took Air India's liability. So there's no guarantee that 23rd surplus will be used for reducing borrowing program. It can be used for something else also. Now, if that is the fear, invariably bond market does not have appetite to absorb 11 lakh crore of net borrowing program. And it is not question of money. Sachchidanand, today between government and banks, we have 10 lakh 50,000 crore cash. And we are worried about 11 lakh crore net borrowing program. So it's not money. It is the risk appetite. Banks are happy putting money at earlier 3.5%, now at 4%, but they are not willing to jump and buy a paper at 6.5 or 7. So unless until we see RBI's aggressive intervention, verbal as well as with money, I think rates are going to rise. They've already risen by more than 50 basis points in a short period of time. Against a global background of rising rates and rising oil prices, without RBI's healing magic touch, rates are here to rise.
Right. Ananth, how do you see this entire story on the fiscal bit that Nilesh bhai just spoke about, the fiscal consolidation and the increased borrowing program? Uh, and in terms of implications for the monetary policy, and how do you see the RBI really looking at this piece? The budget, although we've probably missed the target of the fiscal deficit by say 10 basis points, but we've adhered to that fiscal consolidation path medium term. Um, at the same time, there is this push on capex, which the RBI will probably be happy with, and the growth focus of the budget. But eventually, how do you see this really complicating? Do you see this complicating RBI's assessment and its actions over time? So, your views both on the fiscal side as well as the monetary bit.
No, I think Nilesh bhai put it very well. I'll just add to what he said. Um, First of all, I'll reiterate, this 6.4% was not required. The government has been extremely conservative in its revenue estimates, which make no sense at all. Both for FY22 revised estimates, I think, are on the lower side. I think we'll end up about, I'm saying at least 70,000 crores more than what they have put in. Next year, it would be, I think, at least 1.5 or 2 lakh crores more than what they've budgeted. So they could have easily shown a much lower borrowing program and a budget number. I think they were just being ultra conservative, and I want to be holier than cow also, and tell you that everything. I'll surprise you on the upside later on, I think, was the attitude. It has caused confusion in the markets. Look, if we ultimately deliver on my favorite theme of jobs and output, none of this will matter. If we actually get jobs, output, supply will come in, inflation will be under control, tax collections will go up, there'll be a virtuous cycle of investment, salaries, jobs, savings, investment, and it'll become a nice virtuous cycle. But we don't know how that will pan out. And plus, it will take time. It will not happen in the immediate term. But as Nilesh was saying, if the government says, okay, now I've promised 6.4%, so even if I get extra revenues, I will still go to 6.4% by doing whatever I have to do, then you're pumping a lot of money into the system. You are definitely increasing the risk of inflation. Plus, because if your output does not match up to all this demand you're creating with this money creation, you're also pushing trade deficits higher and therefore causing concerns on the external balance also. As you know, Sachchidanand, right from September onwards, our average goods trade deficit has been at $20 billion plus. A lot of it is gold, etc., but that's been continuing. And you don't want that ghost of 2009-13 coming back again. Combination of high current account deficit, high inflation, high fiscal deficit. Of course, we have tons of reserves, so it's not really comparable. But nevertheless, how long will you just rely on the benefit of reserves? So it is definitely complicating the life for RBI. I think RBI would have liked to ease on this accommodation over a period of time, gradually come to more normalization, withdraw liquidity, hike rates, etc. But if you're doing all that and then you're required to buy bonds because there is no other choice, then you're complicating life completely. And as Nilesh was saying, if across center plus states, it looks like the total gross borrowing program will be at least 24 lakh crores. Net borrowing program will be 18 lakh crores. I can't see how domestic demand can come up to that number unless RBI steps in with some sizable buying. So you're leaving RBI with no choice. You're putting a gun and saying, boss, ab kharido. On top of it, you have statements coming from New Delhi saying rates upar gaya to kya hoga? Jane do upar usko. No, that is not required. Let RBI don't make RBI's life more miserable than it already is. Now, how will this pan out? I think ultimately, Sachchidanand, the bet has been taken, which is that we will push capex, we will push for implementation, we will push for PLI and getting in those 14 sectors, fresh investments, more jobs. That has to pan out. We have to deliver on that. I think that has to be the single-minded focus. If we get growth, jobs, output, all of our sins on the fiscal side, monetary side will get washed off. It will become okay in over a 3-4 year period. We have time because of our reserves. We have time. Now, what happens if we don't deliver? It is not as if the country will collapse. Nothing will happen. We have fantastic people in the country. We will, over the last 30 years, our per capita income has gone up in dollar terms by 6% every year. We've had terrible governments. We've had great governments. But in midst of all this, we've managed 6% growth. 6% growth will continue. But it will be underperformance. We will be struggling with underperformance and not delivering on jobs, not delivering on a quality of life that we deserve, which is really sad given our tremendous operating potential. So, in summary, it is a challenge. It is not as big a challenge as unfortunately the budget has made it out to be, but it is definitely a challenge. RBI has its job cut out, managing inflation, managing a trade deficit, managing this borrowing program, managing inflation expectations. It will be a tough juggling act. I think, again, we'll have to look to Governor Das saying, boss, deliver karo. Medium term, though, this is not a bad strategy as long as we deliver on the execution on this capex and the getting of PLI and the jobs and the output.
So basically, you're saying it's a single trick pony now. I mean, the bet has to really materialize and pay off.
In many ways, yes.
Right. Utpal bhai, coming to you, how do you see the commodity piece panning out? I mean, we've seen company after company and the quarterly results talking about pressure on margins. Almost everybody, all sorts of companies, all sectors facing this pressure. And also, if you can quickly on top of that add your views on this active versus passive share shift in flows, including in say the mutual fund industry.
Okay. So first, let me deal with the commodities question. If you really zoom back and see over a very, very long, over centuries, then essentially human ingenuity has always overcome all commodity constraints, right? Keep that as one significant pillar of your thought process, and then add on top. There is this phenomenal book on the oil sector called The Price by Daniel Yergin, in which he says that the solution to high oil prices is higher oil prices. Okay, and why is that? Because it is when you have higher oil prices that there is an incentive to find alternatives, and which will structurally bring down oil prices over a period of time. Right now, we are at a confluence of supply chain distortions, geopolitical distortions, and so on. And of course, unprecedented global monetary and fiscal push, stimulus. So all these factors together are bumping up commodity prices as of now. Will they persist for the next 10, 15, 20 years? I don't think so. However, they can definitely persist for the next 2-3 years. These distortions are not going to go away overnight. Okay, and what we are seeing is this whole shift to net zero emission will actually change the demand supply balances across many sectors. But what it is doing is, for sectors like copper and zinc, etc., it is changing the demand profile, and that is also boosting prices. The demand side reaction to all of this is instantaneous, or is far more immediate. The supply side reaction to all of this will be much longer. Also, because of greater and greater concentration across all industry sectors, as we discussed, the pricing power is the highest that we've seen in many years, and the competitive intensity is the lowest that we've seen in many years. So the producers are making merry, and why not? I mean, they've seen some bad times, and these are good times for them. But as we zoom out into a larger picture, I feel that commodities may not be the best prices. There is a concept, may not be the best place for asset allocation. There is a concept in Australia called profitable death. Just before a commodity is going to go out of use, people stop investing in the commodity supplies 10, 15, 20 years prior to that, And which is why in the last phase of that commodity cycle, you will have a complete mismatch of demand and supply, leading to the highest prices for that commodity supply. I think if you take a 20-year view, then we may be seeing some of those play out in certain commodities. But for some other commodities, there is a structural change. Coming to
Right.
your second question on active versus passive, I think passive is here to stay. And in terms of incremental allocation, uh, we are seeing the trends, and the trends are moving towards passive. However, the revenue pools of active versus passive are still very different. Even globally, 94% of revenue pool is still with actives, although 20% of assets, more than 20% of assets are moving to passives. I think we should not just look at active versus passive in the mutual fund context. If you look at the asset management sector with a wider spectrum, which means you include hedge funds, private equity funds, venture capital funds, and so on, then the pool of fees available to asset management businesses is actually higher than it has ever been because of unprecedented global wealth, because of financialization and formalization all over the world. Um, I would not be concerned about the shift to passive. I think it is providing a viable alternative to investors, and it is here to stay. It will not kill actives, but actives will have to share the pie with passives and with alternatives.
Thank you, Utpal bhai. Abizer, if I were to look at the finance minister's speech, she used the word digital about 35 times in her speech. And there was also this interesting proposal in terms of digital rupee using blockchain. What are your views on that, and any implications, any issues that you see in terms of the rollout?
So it's not as much debate in India as yet, I must tell you that. Globally, we have around 110 countries actively looking at it. And countries who are not necessarily known for digital currency like Antigua uh, are actually adopted already, the digital currency. So digital currency is a little different, just for everybody, just a little different from what we see as non-paper money. Uh, for essentially, in the way we look at virtual money today, there is always a bank intermediation. There is a payment bank or a wallet or a commercial bank behind it. Central bank digital currency basically means that you're going to hold this currency by the central bank of the country. There is no bank intermediation in between. There is no bank which holds currency. So that is the big difference, and it has many, many implications. Uh, you know, and I don't think we have thought through as much, at least in public domain. Uh, Most countries have actually put out a paper. The US and the UK have come out with discussion papers. And our hope is that India will also come out with a discussion paper, because we will have many unique problems. An economy which is fast formalizing, this is a great way to formalize that economy by getting more and more cash converted into digital currency, and recognizing that digital currency. And I think it'll be a way of more and more people getting formalized into a banking system. It'll ease out credit quite a bit, because it basically means that everything is very transparent. Money is held openly. There are advantages and disadvantages of this whole system. I mean, the biggest point that has been debated is what happens to banking intermediation.
Yes.
Today, basically, you have your deposits which are sitting in a bank, and that goes out to give all the loans for all these huge infrastructure ambitious projects that we just spoke about. Now, how are we going to do this if nobody puts their money in the bank, and banks don't necessarily have deposits to play with? In India, primarily is a savings or a CASA based banking model. And if that CASA reduces to move to a central bank currency, what happens? I think it's in Indian context we have to measure that well. Globally, though, there is a debate paper on it which says that if you price the central bank currency well, so the central bank currency also will be interest earning. Central bank will pay interest. if you price it well, it can actually be the best lever to monitor, to measure, and to control monetary policy. Because then what happens is that decides the flow and the right pricing of credit at the bank's level. Today, some of our large banks have such CASA that they are not able to price credit on the asset side very well. But if the central bank currency, assuming it picks up in a big way, the central bank then monitors effectively what is the pricing of that central bank currency, the return that the individual gets. That will enable a shift of deposits into the banking system. And that will be controlled and right priced, hopefully. So there is many advantages. Clear advantages are transparency and more people coming to the formal economy. 2, better policy management on the monetary side. And the third more important thing, I think, that will emerge out of this whole thing is that the transparency in credit will go up significantly. As you have more and more people come into the digital economy, we've seen that. Even when we had payment wallets, India has the best payment systems. Globally, a lot of people are doing it because they want to have enhanced payment systems. But in India, frankly, with IMPS and RTGS, etc., we have better payment systems than most people. But in our case, the more it comes into the formalized economy, the better it will be for our credit enhancement. Our problem in India is going to be that the more we enable transparency, the more we get into a net of a regulator. And the regulator needs to avoid that and give the comfort to individuals that transparency is not going to lead to bigger problems. And I think if we are able to deal with that.
Yeah. So just two very quick follow-up questions on that. If this is an interest-bearing, say, instrument, it is a liability on the central bank or the banking system?
On the central bank.
Yeah.
So
okay.
So that's important also. It's a liability on the central bank, and hence your whole deposit guarantee insurance eases out because it goes to the central bank.
Yeah. Also, I think if you look at the past couple of decades, every single decade we've seen 2 or 3 bank failures in India. Not massive in terms of scale, but I mean, it could be some of these smaller private banks and things like that. In a scenario,
larger banks have been merged into others. So that's why we don't.
Yeah. So, I mean, in that scenario, what happens if there is a bank that runs into trouble? Will it not lead to a faster run on the bank? I mean, if you have a CBTC?
Well, it does not necessarily say it does not, because if the bank has deposits, and then obviously there will be a run on the bank if the bank doesn't perform well. That can anyway happen. So effectively, from what you're saying, that the bank's treasury management will have to become completely changed, because deposits will have an avenue, and that avenue will be the central bank digital currency. So somebody can easily pull it out and put it into a central bank digital currency, as they can do to other banks. See, there was stickiness in deposits, but as banks got jittery, we've also seen that people have moved deposits from one bank to another bank.
Yeah, but now
you're saying they'll move money from a bank to a central bank currency.
It might induce a faster.
That's one more avenue. It's one more avenue. So that can anyway happen. So run on the bank can certainly happen. So today, the way we manage liquidity within banks will have to undergo a significant change. Yes.
Right. Okay. So I think we're running out of time. I'll just go to each one of you asking one biggest miss from this budget. Each one of you, very short answer, and also your rating of the budget. I mean, this is something that we do for the galleries. So Nilesh bhai.
So one thing which this budget missed out is to probably give support to bottom end of consumption. Maybe an urban Manrega, or maybe some incentive to taxpayers so that they are left with more money to spend would have been better.
Right, and your rating, Nilesh bhai.
Rating, except the conservatism and the estimates, it is in right direction. So 8.5 out of 10.
Right, Professor.
Sachchidanand, I've talked about a few misses already, but the biggest miss, as far as I'm concerned, is the lack of direction, the same direction that you showed on capex, the lack of that direction for education, healthcare, nutrition, etc. I would have really liked that. Another area I would suggest that we should all look at a little closely is state finances. We talk a lot about central finances. States are in a mess even now, and unfortunately, their devolvements from the central government is also coming down, as you know, Sachchidanand. But anyway, for one thing, education, healthcare, I wish we had a lot more. In terms of rating, yeah, I'm an armchair professor, and I use the red pen a lot. So the Dil Mange more, and I go 7 out of 10.
Good one, yeah. Okay, Utpal bhai?
I would say that the credit cycle is behind us and the capex cycle is ahead of us. To have interest rates spike at this point of time, to have a bond market, which is in a foul mood at this point of time, is not helping anyone. And I would say that this was not necessary. It was entirely avoidable. So I feel, that this is the biggest miss in the budget, because then we would have had like Sarva Gun Sampanna budget. Uh, so I would rate this budget as 8 out of 10 on this count.
Right. Abizer, your
Yeah, I think the
message?
one thing that this budget misses out in any form of policy is to address the inequality in India. We've all seen great corporate results, but if you look at MSME, which employs what 80% of India, we are terrible. And the business models there are getting much more incompetitive. I mean, I'm sure at least 30-40% of our MSMEs are traders, and trading arbitrage has vanished. How are people going to do business going forward? Their business models are broken, and we don't have a solution for that. And I personally think that we hope that all these infrastructure spending, capex, etc., will trickle down jobs to the people. It never has happened to a great extent. We have a slightly hypocritic capitalist economy, and I think we will stick to that. There will be more concentration towards that, and that's not going to help the economy. And I don't see any kind of democratization in this kind of infrastructure spend or capex, that cycle that we see. I hope that happens as we go ahead in the implementation. So again, it's 7 out of 10.
Strong words. So thank you so much. I think in the interest of time, we won't be taking questions from the audience. We've hit 5 already. So just to summarize, I think, like I promised everyone, we have got nuggets from each one of these gentlemen here, and thank you so much, each one of you, for your time and sharing your expertise and experience. I've got a couple of things. One, extremely positive. Everybody's looking ahead with a sense of optimism. Nilesh bhai spoke about how this budget has moved from Sita Gita to Navrang. Lot many, he's added a dash of color. Professor Ananth Narayan spoke about the K-shaped recovery and the importance of job creation. Now, for a lot of people, I just want to bring this about. Somebody who's been out and out a market talking about jobs and K-shaped recovery is really heartening for me to see, and for everybody to see. So, Professor, thank you for articulating a lot of those. And also some of these baggages of the past and how we should be looking ahead with a fresh lens, although with a sense of optimism. And also something interesting. I'm sure people would have heard that profitable death concept that Utpal bhai spoke about. So thank you so much, each one of you. And we saw the professor and Abizer not really use the red ink, but yeah, 7. We'll take the 7 out of 10 for this budget. So thank you so much, each one of you. I'm handing it back to DG. Over to you.
Thank you.
Thank you.
Thank you.
We went through all the aspects of the budget, and I think unanimous view is that this is a very positive budget, simply because it's going to help us in infrastructure a lot. So thank you for all your views, and thank you, participants, for joining us today. I'm sure all of you would take back a lot of insightfulness from this session today. My thanks to our partners, Kotak Mutual Fund, Axis Bank, Tata AIA, and Sai AIL, Sai APL. And apart from that, my team, Sugita, Priyanka and Aishwarya, Prashant and the marketing team, and Zarl for bringing this to us. And hope to see you soon for another webinar. We have a couple more plans on different topics, and we'll inform all the members about these in the days to come. Thank you once again. Have a great weekend and stay safe.